So today, I think it's the first meeting that we do on LinkedIn, and it's the first of a series in which we're gonna talk about our index and then our DAO. In general, I mean, the first meeting will be just a presentation, a general presentation, but then in the following meeting, they will all be mainly focused on discussions about the asset management, the portfolio management of this index. So getting all the input from the team and the community, because as a DAO, it is to be accessible to everyone. So it's very important that everyone can express their opinion and their opinion are taken into consideration. However, the first calls are going to have like a different format because we're still in the background research and creating the index. So we're just going to do a bit of education on our research and our index. And today we're going to focus mainly on the actual composition and weighting of the assets of the index. Let's call it like the strategy of picking those assets and how to weight them. To give a little bit of overview of what portfolio selection is, I mean, is that you are basically trying to find the best combination of the assets regarding to your objective. So the best combination is the key word here because you want this asset to be as um, uncorrelated, as how do you say, diversified as possible to achieve your risk goals. And this is very important in the creation of our index and how it will perform. There are two main theory of portfolio management, which are modern portfolio theory and capital growth theory. We are gonna mainly focus today on modern portfolio theory because it's the most adaptable one to our use case. And this is also referred as mean variance optimization model. And it basically focuses on diversification as the core of the theory, and diversification as a tool to obtain the maximizing the return for the lowest risk reward ratios. And it's classified as a risk-based model. So you are trying to minimize the risk and maximize the return. We're gonna obviously compare this strategy, this theory, this model with other models. I think that the main competitors in the space of this type of risk-based model is the risk parity portfolio. So this is a bit different. So the aim of this portfolio is to actually share each different asset as to contribute to the same to the risk, to the volatility of the entire portfolio. So they equally weighted, so that each asset has the same risk and volatility. So to compare between the two, the modern portfolio theory or medium variance optimization, the aim is to minimize the variance, so the diversification of the portfolio and the correlation between the different assets, while the risk parity portfolio try to choose the asset that contribute equally to the overall volatility of the portfolio. And yeah, these are the main two ones that we're gonna compare, but also we're gonna compare with all the different other strategy on the space, and also the other indexes, like the classic, like 10 most market cap, and see how they behave, which one underperform and overperform. And yeah, so this is trying to find the best possible management strategy for a portfolio based on back testing and performance. So yeah, I mean, our goal is to demonstrate the benefit of the medium mean variance optimization model on the diversification, the benefit of the diversification of this model to our portfolio. And yeah, I mean, to benchmark this model against all the other different ones and compare between them. one of the things we're going to try to focus on while choosing this model, and then in general while constructing our strategy, is going to focus on market inefficiencies, because there is a big opportunity, I mean, in the cryptocurrency space and the market, because it's a very new and efficient market. And when there is an inefficient market, you can create a model that uses these inefficiencies to outperform the actual market. So yeah, this offers an opportunity, investment opportunity for portfolio management of making excess return based on these inefficiencies to outperform the market. And there's many papers that outline this, that it's possible to propose profitable strategies by providing example of these inefficiencies. So you have to factor in these things as well. For example, one of these inefficiencies that you need to factor in while portfolio management is liquidity. So, for example, we have the classic strategy we're going to talk about, which was the medium variance strategy, or in general, it could be just like weighted market cap weighted strategy, in which you weight the different assets and the composition of the index. But you also need to consider liquidity. So there's many paper in the space and many in many indexes, the actual weight, and around 25% of the weighting of the asset is based on liquidity. And yeah, so we're gonna explore how we can improve the performances of our strategy, considering this condition of the market and the liquidity of the assets. For example, we can add to our risk criterias a module based on the spread and the liquidity that there is for each asset. And that's because, I mean, we need to factor in all the different frictions that you get while trading this asset, and with liquidity is one of them. Okay, so this was the main core of the presentation, but I wanted to dive a bit deeper on I mean, what is our mentality, what is our goal on finding the strategy. Um, so in general, I would say the opportunity in the cryptocurrency market is very high, and we see many of the index out there. They use a very simple strategy based on just waiting for market cap. However, we can apply classical model portfolio theories to the crypto market by having the right selection process. For example, I mean, one of the main critiques of the cryptocurrency is like the high volatility, which is also good, for example, for high return. And then, but it becomes very hard to do back testing and to apply these models. So it's going to be crucial for us to choose, select the selection part. So this is a strategy. This is a strategy we're going to try to apply, and we're going to try to back test. But first, you need to select the different asset that you're going to back test again. For example, you cannot apply these models to so many volatile and with small history tokens, and then there are so many of them. So you need to restrict the set. And many restrict by market cap weighting, which is not really the best because you're going to lose so many of the outperformers of this asymmetry, this market inefficiency that you can, from which you can get the upside from. So we are, the next call is going to be focused on how we select these different assets from which you do backtesting with. We're going to explore different let's call it clustering, let's division selection of these models, which could be focused on risk or volatility and other factors. So I mean, that's the aim of the next call. But before then, we can start thinking about what asset we would like into this portfolio. So we could open a discussion for it if anyone has any feedback, any input on this. And yeah, I mean, as I said, this call is mainly just a presentation. So the next call would be more open to discussion, and anyone could actually bring their inputs.
I would say have a nice evening, have a nice Saturday evening, and yeah, talk soon.
Thank you, guys.
Ciao, guys.